Welcome. We're grateful that you're all here, and welcome to the middle of 2023. I'm Sharon Joseph. With me tonight presenting is financial advisor Jim McAfee. Supervising is financial advisor Jody Donovan. And we're assisted by Jenny Jones and Chris Williams. So we're all glad that you're here. So we're halfway through 2023. It's been a lot better than 2022, right? Just as a reminder, 2022 was a year that was so bad. We haven't had a year that bad since Richard Nixon was in office. Wow. But we survived, and we're all still here. So that's great news. But now that we're in 2023, we are in a time of transition. You've had a great 2023 if you had a growth portfolio and had technology stocks in it. But if you had a stodgy old value portfolio that you were investing for dividends, you had a flat year so far. It hasn't been that great. So that's kind of a bifurcated. So we're moving from a time of unbalance to balance. We've been really unbalanced. This year so far, 7 stocks are up 20%. 7 stocks out of the S&P 500. That means there are 493 stocks that just went sideways or down. That's unbalanced, wouldn't you say? Yes. We've also had unbalance when we had 0 interest rates. That's not how it's supposed to work. Well, that's basically free money, and that free money led to almost 9% inflation. That's out of balance. Well, then we had to start raising interest rates. That's not balanced. So we raised interest rates in investments. Stocks or bonds did not like that at all. So it's great that we're in transition. That's really good news. What we're going to end up with when we get balanced is you can have a growth portfolio or a value portfolio. You can have a global portfolio or you can have a U.S. portfolio. You can own technology, but you can also add healthcare, energy, and industrials in with it and have a diversified portfolio. I see Molly laughing back there because she's in an investment club that is not diversified. They own Apple and Google and tons of it. So, getting back in balance brings a lot of opportunity. Well, when we use the word opportunity in the investment world, the other word you should hear is risk. So there's also a lot of risk. There's economic risk, there's financial risk, there's policy risk. So what I'm basically saying is we may have some short-term discomfort in the form of volatility, but it's going to lead to long-term benefits, in our opinion. So our presentation tonight is divided into 3 segments: the macro economy, the equity market, and the fixed income market. All the slides that we're going to use tonight are in your brochure. They're supplied by Capital Group, home of American Funds. And each slide presents an investment premise. And then the chart or graph underneath it supports the reason that we believe that premise is true. So if you can't see Jody said you can't see some of the little numbers up here. All the little numbers are in your brochure. So we ought to be able to get you all the information that you need. Okay, so remember I said there's a ton of cash on the sidelines? Mac's going to talk about that.
You're clicking.
Okay.
All right, click. And as you can see, this is not a diagram of the Himalaya Mountains. This is cash in money markets sitting on the sidelines from 2008 up through 2023. And I want to go back in history a little bit to 2008 to start this. And in 2008, everybody knows what happened then, right? The Great Recession. So when things started going south and people's portfolios started falling off the mountain, people took their took their stocks and their bonds, converted to cash, and went into money markets. And it went in so much that it set a new record. And the new record was $3.9 trillion. That's with a T. That's a lot of money, folks, sitting on the sidelines. So as you can see by this, if you can see this or you can look in your handout, the trough that occurred in 2008 occurred in March of '08, and people started going back into the market. And as you can see, what happens to the cash? It starts flowing off that mountain back into the market. And then we have about 10 years or 12 years of fun and games. Everybody enjoyed that. There were little blips in there, but overall it was good. Then comes the pandemic of 2020. What happens then? People really panic. The supply line shuts down. The country shuts down. People run to cash again and set a new record of $4.7 trillion. A lot of money sitting on the sidelines. Well, that panic lasted 2 months. From March until May of 2020. And then the market started picking up again, and people started going back into the market out of cash. As you can see, money flows out of cash back into the market. And then what happens? The war in Ukraine, political turmoil around the world. People get afraid again and start going back into cash. As of May the 31st of 2023, there was $5.4 trillion in cash sitting on the sidelines. So now we're going to have a little short history lesson. If you look in the middle, you can see where the S&P troughs were. The first one was in March. Is that right? Yep. March of 09, excuse me. 3 months later, your portfolios had increased 40%. 6 months after the trough, your portfolios had increased 55%. I assume that everybody liked that. So once again, let's look at the next one, which is the pandemic. What happens then? At 3 months, we were 41% up. At 6 months, we were 45% up. Once again, I assume that everybody enjoyed that. So what this is telling us is that history tells us that there's a lot of cash sitting on the sidelines. And when this turns around, sitting on the sidelines is not the place to be. The place to be is back in the market. And that's where we're going to our next slide to talk about one more thing. Oh. No, that's good. That's good. Next.
What about inflation?
Everybody has inflation. You don't have inflation unless you haven't been to the grocery store and bought food. If you haven't done that, you're not too worried.
Actually, the highest inflation is someplace to live.
Well, that's true. That's true.
You already have someplace to live, so you only notice the grocery store.
That's true. That's true. Okay. So what we're seeing here in 20, when things didn't look so good, the pandemic was upon us, the supply chain was tanking, prices were going through the roof, went all the way up to 9% inflation. Nobody liked that. Nobody. So what happened? Fed started raising rates. Slowly but surely, the supply chain has improved. And as you can see, interest rates have come down to where today they're about 4.5% or 5%. But projections show that by this time next year, the Fed hopes to be around the 2 to 2.5% mark on inflation, which is where they try to be. The average inflation number since World War II is at 2.5%. So
just in case you thought that it was only in the U.S., you've got this slide that shows it was even higher in the United Kingdom and the Eurozone. So it's a worldwide inflation.
Your turn. Okay.
So as inflation has eased, rate hiking rate hiking nears the cyclical end. So what we have is 15 months of the Fed raising interest rates. They raised 9 times over this time period, and it went up went up 5 percentage points. So we went from 0 to 5%. But now the market has implied that the rates are going to go down now. Now, what do we mean by the market has implied? Well, remember, the Fed only sets interest rates overnight. It's what the Federal Reserve Bank charges its member banks to borrow money overnight. So that's a short-term interest rate. But the markets, all the markets react to what the Fed does. So when we say the market implies, it means that all of the people in the world who buy bonds, and that is countries, banks, universities, pension funds, foundations, all the people that buy bonds are indicating by the purchases they're making that the next direction for interest rates is down. Okay? So we've talked and talked and talked about recession, and we're still saying recession is likely. There are many indicators that economists use to predict recessions. Some of them are saying no recession. Some of them are saying recession. So we're still saying it's likely, but the recovery will be stronger than expected. So what I want to do in this graph is justify why we think the recovery of the recession, whether it's deep or shallow, will be stronger than expected. So we've gone back to 2000, and we're looking at the financial health of corporations and of households. So the turquoise line is the ability of corporations to cover their debt. So back in 2000, corporations could cover their debt at about 9.5 times. So they had 9.5 times more money that they needed to pay their debt than they had. So the recession of 2000 came along, and you can see that their ability to cover their debt came down. And then after the recovery, it came back up, and then came the Great Recession. Again, their ability to cover debt came down, but not nearly as low as it was here. Then we go through these healthy times, and they build up their cash. Well, when the recession comes, again, they use up their cash because they shut down the corporate business, but they still had to pay for their debt. So that would pull that down. Well, after the pandemic was over and the government flooded the country with money, corporations saved that money. They didn't spend it. They're holding it. So right now, they have 13 times what they need to cover their debt load. That's very, very healthy. Okay, so let's go the other way and look at households. So the blue line is households, and it's reversed. What's good here is for corporations. The good is what's bad here in the turquoise line is reversed in the blue line. So this is the percentage of disposable income that a household needs to pay their debt. So way back here, it took 12.5 times what a household made in income to pay their debt. So when the recessions came, both of them, that came up higher because they might have lost their job. It might be a couple and one of them lost their job, but they needed more to cover their debt. After the recession, they brought it down to where they were only took about 10% of what they made to cover their debt. So that was a very healthy situation. During the pandemic and the money that came into their hands after that, they've now raised it where every household on average it takes 9.7% of what they make to cover their debt. So both of these situations are very healthy. This is a really important slide in our total presentation, so I'm going to stop and say, does anybody have any questions? Does this make sense? Okay.
Remember, we were talking about those mountains of cash, and remember I told you to look when things improved, how the cash decreased and people went back into the market. Well, when they did go back into the market at the end of the Fed rate hike cycle, things improved dramatically. Going back to 1995, this will be the fifth Fed rate hike cycle, and the other four shows that from 0 months to 12 months, U.S. bonds, U.S. stocks, non-U.S. stocks, short-term bonds, they all went up faster than cash did. The thing about this is, in the first 12 months after the Fed stopped raising rates, the majority of the returns occurred in the first 12 months. So once again, I stress that now may not be the time to be in cash. It may be the time to be out of cash and then back into the market.
So I also want to call your attention to the fact that the 60-40 portfolio, which is what's recommended for most people that are retired, I can look around that room and say that's most of us. The 60-40 portfolio did very well too after the Fed quit hiking rates.
A stronger and a longer term outlook we think is going to occur over the next 20 years. This is Capital Group's assumption of returns that we're going to see over the next 20 years in U.S. stocks, non-U.S. stocks, emerging market stocks, and also in bonds, U.S. aggregate bonds, U.S. high-yield bonds, emerging market debt. And if you look over here on the right, you can see what they think cash is going to do. Now, this is a projection. This is not chiseled in stone. And the dark blue line talks about 2023, which is where we are now with all this money sitting on the sideline. The other line is 2022. It's in the past. We're concerned about 2023 right now. And so what this tells us is that they think that in the next 20 years, we're going to have positive returns in stocks and in bonds.
So where would we make the most money? If we had money to invest in 2023, where does Capital Group think we're going to make the most?
Emerging markets.
Thank you, Jody.
Thank you, Jody.
I was just about to ask what EM meant.
Emerging markets. Thank you for asking. And stop us if you see any of this stuff that you want, like Liz just asked, what does EM mean? Emerging markets. We're going to talk more about them in a minute. Oh. Yes, sir.
U.S. aggregate mean?
It means if you take
Go ahead.
U.S. aggregate is for bonds. And it. Oh, sorry. George asked, what does U.S. aggregate mean here on this graph? And what it's talking about is if we take corporates and treasuries of all maturities and we put them all together, that's aggregate. So if someone were to buy just a plain old bond fund, they would be buying the U.S. aggregate. Whereas U.S. high-yield bonds would be the lower-rated ones. Some people call them junk bonds, and these would be emerging markets. So this would be what we think of as just general bonds, treasuries, and corporates. Thank you for your question. Anybody else? Okay. So this one's important, too. So I'm going to slow down and try and make it make sense because it's complicated for me. So I always have trouble with if the dollar's up or down, is that good or bad? So the dollar is up and down all the time. So what this is the path of the dollar going back to 1978. So you can see it's compared to all other currencies. It is still the dominant world currency so far. But it goes down, it goes up, it goes down, it goes up. But what this wants to illustrate to you is what happens to international stocks with the movement of the dollar. So these little arrows at the bottom here are the MSCI EFA. Okay, MSCI is a Morgan Stanley Capital Index. So it's an index put together by Morgan Stanley. And EFA stands for Europe, Asia, and the Far East. So it is an index of the developed world. And the little arrows say, how did their investments do when the dollar was up or when the dollar was down? So when the dollar was going down, the EFA market went up. When the dollar's going up, the EFA market went down. And so I would have bet, because this is my portfolio too, that your portfolio is a little short on international stocks because we have had 11-year bull market for the dollar. For 11 years, the dollar's been going up. What has that done to international stocks? It's made them go down 233%. We think that's changing. We want to be ahead of the changes, not behind them. So the dollar, since October of 22, the dollar's come down 6%. We think that's an ongoing trend, and it's a really good time to invest in international investments. Mac, want to tell us about some international investments?
Sure. Let's talk about Europe to begin with, and then we'll move on to the big dog, which is emerging markets. But in spite of the war in Ukraine, in spite of high interest rates, and in spite of their Fed hikes, some companies in Europe have done well. Not their whole economy, but some companies. And they picked out 5 that I want to talk about. Novo Nordisk is the first one, and it's located in Denmark. It makes diabetic stuff. It makes medicine. It makes the tools that we need to treat diabetes. And as you can see by the wheel in the different colors, you can see where the breakdown is for United States, Europe, Asia Pacific, Latin America, Africa, and others. And for Novo Nordisk, because they treat diabetes mainly, their big partner in all this is United States, because we have such a problem with diabetes in this country.
So we're the biggest market.
I'm sorry?
We're the biggest market.
We're the biggest market for Novo Nordisk. Yes, we are.
What is it, 44%?
48.
48% of Novo Nordisk revenue comes from the United States.
Right.
Even though they're a company that's domiciled in Denmark.
The next one that I want to talk about is Nestle, and it's located in Switzerland. And Nestle makes the very best. That's it. Chocolate, that's right. They are one of the world's largest distributors of chocolate, but that's not all. They also distribute water. And I would bet that almost everyone in here has had a Nestle bottle of water at some point in their life. Another thing that they make is Boost Energy Drink, which is a big seller here in the United States. Moving on to the next one, Airbus, located in France. What does Airbus make? Airplanes. That's correct. What kind of airplanes? And the answer is not the kind that fly. Okay? So what kind of airplanes do they make?
Really big ones.
They make civilian and military airplanes. So there's always a market for their product at some point in time. Probably almost everyone in here has flown on an Airbus at some point in time. How about Louis Vuitton, located in France? Did you know that last year Louis Vuitton had revenues of $89 billion? That's with a B. $89 billion. The majority of that came from the United States and Japan. But Louis Vuitton is hoping that with China opening back up, that's going to be a big demand for them too, which will even increase their revenues even more.
The biggest thing on the pie chart is Asia and the Pacific, because
Japan.
Japanese and Chinese love those expensive things.
Right.
It's not just Louis Vuitton, it's also Moët Chandon champagne and Hennessy cognac. So it's a whole range of luxury brands.
The last one, but not the least, is ASML. ASML is a equipment maker located in the Netherlands. And the equipment that they make is used to make chips.
Potato chips?
Not potato chips. The kind that are in your phone. The kind that are in your car. The kind that are in everything else. So as you can see by the wheel, the majority of their business is in Asia, which is where the majority of the chip makers are. So As you can see, it's not the country that we choose, it's the company within the different countries that we choose to look at. And to do that, you have to have excellent research, which Capital Group does have, because they have offices all over the world.
So remember I said there are a lot of opportunities. So we're talking about these as opportunities. Opportunities to invest in stocks that are outside of the United States. But there's also opportunities in technology. Do you feel like technology is just coming at you like a storm and things are changing so fast you can hardly keep up with it? Well, you're right. But that also provides all kinds of great investment opportunities. This graph shows you how fast we assimilate new technology. How fast do these technologies get to be 1 million users? So the old long one is Netflix. It started in 1999 and took it 3.5 years to get 1 million users. But Facebook came out in 2004, and it only took 10 months to get 1 million users. Well, Chat GPT came out in 2022, and in 5 days it had 1 million users. Does everybody know what Chat GPT is? It's artificial intelligence, and it's natural language processing data. So you can say to Chat GPT, as a student, I may want to say, write me a 1,000-word theme paper on the history of Texas. And that's all you have to tell it, and it'll gin it out. I'm glad I'm not teaching anymore. I wouldn't know how to deal with that kind of thing. Or I want my resume, and these are the jobs that I've had. Now you fill in all the, and the English part of it and all that. So it actually just writes like people talk with just a few commands. So you can see why it took only 5 days to get 1 million users, because writing's hard and people don't like to do it. So we're going to let the artificial intelligence do it. Okay. So that's technology. So we've talked about opportunities in Europe. We've talked about opportunities in technology. But if you're not that excited about that, see if you'll be excited about this. We are.
We're going to talk about dividends, and yes, we are very excited. And for those of you who know me very well, you know that I'm a big proponent of dividends and have been for a while. If you'll look on the left-hand side, you'll see a graph that shows how dividends have increased in Japan, in the U.S., and in the world. And it's gone steadily upwards. And the projections are, using the CAGR, which is the compound annualized growth rate. Can't believe I remember that. You can see that they expect that to continue to grow out through 2025. That's outstanding for everybody who owns dividend payers.
This slide's just for George, right here.
George, you just have dividend payers?
George
yes.
loves dividends.
Yeah, buddy. Me too. The other side of the slide shows the sectors in the MSCI All World Country Index. And what that tells us is that if the highest one is in energy and the lowest one is in information technology, well, someone may say, well, why wouldn't I put all my money in energy to get the best dividend return? Who in the world is going to put all their money in one bag? You need multiple marbles in that bag. You need to be diversified. That's pure and simple. Okay? A good example of that is, I can't read this, it's too small, but...
What color?
Which one?
What color?
No.
Consumer
Oh,
No.
healthcare. You want healthcare?
That's the one I want. Healthcare. What's the number up there? 1.8. Did you know that Abbott has increased their dividend for 50 straight years? So you think their dividend's 1.8? I'm pretty sure it's not. I don't know what it is, but I'm pretty sure it's not that. European beverage maker Diageo,
Which would be a consumer staple.
That's right, has increased their dividend for 20 straight years. So dividends are going to be playing a super important role in our portfolios in the coming times that we're getting ready to go through.
Okay, so we get these slides and we're going through them and we get to this one and I say, wage growth is finally coming to Japan amid higher inflation. And he goes,
Who cares?
well, we do care. Wage growth is important. The people in Japan spend a lot of money, but so do all the people in all these other countries. So what this is not just focused on Japan. This is saying that wage growth is everywhere, and all of these people can go shopping. The United Kingdom can go shopping. The United States can really go shopping. France can go shopping. Germany, they just have to stay home. But Japan can go shopping too.
Remember, the United States is buying all those luxury items from Louis Vuitton. They got the money to do it.
And Japan's buying a whole lot of them too.
Well, that's true.
So what about China? That's
boy.
another who cares.
As you've heard in the news, China is just now starting to reopen. Their government kept them shut down because of COVID a lot longer than we were shut down. And as they open, there are certain sectors, and that's what we see on this slide, are different sectors that are attractive to investors because their price to earnings ratio are below the 10-year average. So that makes them very lucrative to some people. Like McDonald's and Starbucks, they're both building new stores in China. Louis Vuitton is looking for China to be a great contributor to its bottom line coming up. So China is a good place to invest, but you wouldn't want to pick your own stocks. So what you need is someone who does that for you. And as an American fund fanatic, I need to tell you that they have offices in Hong Kong, they have offices in Singapore, they have offices in Tokyo. They live it day to day. So I think that they are better positioned to offer an insight into China than we can get on our own.
So I've always wondered, how do you buy a stock, which is a capitalist thing, in a communist country? I don't know how, but I know that American funds knows how. They know when to get in and when to get out.
And one more thing on that, before I leave, is you got to take into consideration the risk factor. You know, China's beating their chest pretty hard about Taiwan. Who knows what's going to happen there? So if you've got the stomach for the risk, it may be a good place for you, but I don't know. I'm a little hesitant myself. All right, your turn.
Okay.
I am.
Okay, so this is another one of those complicated slides that we're going to take some time with to understand. So we've moved into the fixed income area, so now we're talking about bonds. And the premise is, as the Fed takes a pause, value can be found in the rates market. When we say the rates market, we're saying that the bond market. We've had 10 years that the bond market has not been very good. And so now, as the Fed pauses on raising interest rates, we have some real opportunities there. So this goes all the way back to 1981, and you can see we have the 5 recessions. The gray bars up and down are the recessions. So one of the things that we use to indicate how the bond market is doing is we compare the 2-year Treasury to the 10-year Treasury. So if you loan your money to the U.S. government for 2 years, or you loan your money to the U.S. government for 10 years, which one should pay more? The 10-year should pay more. When the 2-year pays more, that's an aberration in the market, and it's called an inverted yield curve. You may have heard people talk about it, but the inverted yield curve is when the 2-year, or when the short term, not just the 2-year, but we use the 2 and the 10 to make a graph, because you have to pick some number, but it's when the shorter term ones pay more than the longer term ones do. Why would that happen? It would be because investors are worried about what's going on in the market. So I'm going to think about buying CDs. I'm going to buy really short-term CDs because maybe it's going to go higher if we have a recession. Maybe it's going to go lower. I just want to be liquid. Well, that's what bond buyers are doing in this situation. So 0 is when the 2 and the 10 pay the same amount. So when it goes below that, like it did right before the 81 recession, that's an inverted yield curve. So if you will notice, the yield curve becomes inverted pretty much before every recession, even almost the pandemic. Well, we have a hugely inverted yield curve right now. Remember I said that economists use all kinds of indicators to decide whether there's going to be a recession or not. This is one, and some of them are tracking strongly for a recession, and some of them are saying there may not be one. This one is tracking strongly for a recession because the bonds are so clearly inverted. So, when we have a recession, what will the Fed do with interest rates? What did the Fed do when we had a recession here? They began to lower them. Okay, when you lower interest rates, which way do the value of bonds go? The opposite. So if interest rates are going down, the value of bonds are going up. So right now you could come in and buy a bond or a bond fund that has a higher interest rate, and if they begin to raise interest rates, if they begin to lower interest rates, those bonds will go up in value. So this is a point that this is a really good time to be buying bonds. Did I make that make sense?
Sounds like a win-win.
Right, because either way, and that's a good point, it is a win-win. Either you lock in the good rates now, and if you're wrong, then the rates go higher. But if you lock in the rate and rates go lower, you have the rate and the higher value on the bonds. So this graph says that we will probably have a recession. Our estimation is there will be a recession. It will be short and shallow. So, corporate bonds, so we divide bonds into treasuries, which we just talked about, into corporates. And in corporates, we have the high value ones, the high rated ones, and the junk ones, the lower rated ones. So this is talking about corporate bonds that are higher rated. And it says corporate bonds can likely weather the economic slowdown. Remember the slide we had that showed how healthy corporate bonds are and how they have plenty of cash to cover the debt service that they have? So this is saying if you buy in the fourth quartile, so if you buy a bond now that pays 5%, that it's likely in 2 years to yield 6% because of the value of the bonds going up. If you look at the lower rated ones, the junk bonds as they're called, you lock in a higher rate right now, and historically those patience will pay off. And I don't see that patience is actually, 2 years is really not a very long time in my investment world. But they say if you buy a junk bond fund now, lock in the higher rate, like if you lock in 7 or 8%, in 2 years it'll be worth from 7.9 to 9.2%. So this is saying jump in here and 2 years later it's higher, and jump in here and it's two years later it's higher. So they're just saying it's a good time to buy bonds. One more time, we're kind of wearing that out. Okay. Yes, ma'am.
What's a quartile? A quarter?
Say again.
A quartile is a quarter in month period?
Yes. These quartiles, though, are not quarters. They're not quarters of the year. They're quarters of the payment of bonds. So this is the lower quartile, mid quartiles, and the fourth quartile. So they took all of the interest rate that bonds could pay, and they say this is the lower quarter, the mid quarters, and the highest quarter. So what we're saying is we're in a high quartile now. So if you lock up this rate, you should be, because you're locking up high rates, then you end up with more total return over time. Okay, back to emerging markets.
Okay, it's about time. If you remember when we were looking at the projections that go 20 years out, that emerging markets were really looking good. And what this graph tells us is that if you were in Asia, where
they didn't have a lot of inflation?
Yes.
That inflation number looks really...
Where the inflation was kind of held in check, that their policy rate, which is their Fed rate, okay, policy rate translates into Fed rate. As you can see, their inflation rate has been held kind of in check. If you move to Latin America, you can see that they've done a better job with inflation because they have anticipated inflation, and so their central banks have raised rates at a faster rate to try to slow down inflation. Okay? If you go to the next one and you look at Eastern Europe, it looks awful. Their central banks have been slow in raising rates, which has caused inflation to skyrocket. Look at Hungary, 25% inflation. So if you were going to be an investor, which one of these would be the most likely one for you to invest in? I'm sorry? Not in Western Europe. I wouldn't, but either Latin America, some in the Far East, but mostly in Latin America, that's where I would be looking for good companies to buy. So
go ahead, I'm sorry.
So, like we said, emerging markets we think are going to be outstanding in the years to come.
So did we make it clear what emerging markets are? They're countries that are in the stages of development. If you look at the list of them, you can see these are not, this is not the United Kingdom or Japan or Germany. They're not sophisticated, developed countries. They are developing countries.
Right.
So what we're saying is that there are good opportunities out there in these countries that are just now developing because they have companies in them. To be really honest, they have companies in them that aren't as restricted as companies that are going public in the United States or in Canada or those kind of places. So they can invent something and really get it out on the market and make a bunch of money for their investors. So that's why we're looking at emerging markets.
A good example, as far as investing in emerging markets, I just thought about this, is let's just take China. Okay? China is improving their way of life. How many people in China you think need toothpaste or toilet paper? Things you don't think about. But those companies that are going to supply that stuff may be companies to invest in because the demand is going to continue to increase. Latin America essentially is the same thing. So, That's all. It's all yours.
Thanks. Because my favorite subject, municipal bonds. This is a muni moment. Now, I've been touting municipal bonds for years and years, but they've never been as good as they are right now. And you can see that from the graph. We go back all the way back to 2012. These are the rates that we were able to lock up. And the average over the last 10 years is 2.29. Now, that doesn't sound like much, but if you're in a high tax bracket, it's more like 4%. So right now, muni yields have gone really high. We missed this peak right here unless you bought some. But the average right now for munis is 3.64. So if you're in the 30% tax bracket, that's like getting 6% because you don't have to give a third of your money to Uncle Sam. You get to keep it all. And one of the benefits we have here in Texas is because the state is so diversified, you can really build a diversified municipal bond portfolio where some school districts, some municipalities, some water districts, some all different
hospital districts?
No, not those. No, we don't buy hospital bonds. They're not making any money. But anyway, it's a really good time for municipals. So if you're in a high tax bracket, keep that in mind. So, as we said, we're going to talk about
the macro perspective.
Mountains
of cash. Mountains of cash.
When we say macro, we're talking about the whole world. If in college you have a macroeconomics class, it's everything that's going on in the world economies. So from the macro perspective, we have mountains of cash.
Mountains of cash.
A recession is likely, but it'll be short and shallow, and the declining dollar is a boost for international stocks. From the equity opportunities area, when we're talking about stocks, we're talking about
new growth opportunities.
You telling me or them?
Them.
The adoption of new technologies provides some real opportunities, as does dividend growth and emerging markets. So when we're talking about equities, which is another word for stocks, we're talking about stocks. They're all different kinds of opportunities for all different kinds of investors, both aggressive and conservative. And finally, fixed income opportunities. Fixed income is the other word for bond. I've never understood, when I first got my license, I couldn't understand, is it equity or is it stock? Well, they're interchangeable. Is it fixed income or is it bonds? Why can't we just call them one? Drives me crazy. But anyway, fixed income is the other word for bonds. So fixed income opportunities.
The Fed pause is going to provide value.
So we think the Fed may raise one or two more times, but if they do, they're going to be tiny little raises. They may raise one and then call it off. So that's going to provide great opportunities in the bond market. And we're going to have more balanced yield, and that's great positioning for buying stocks. And of course, if you're in a high tax bracket, you need to think about municipal bonds or municipal bond funds.